No debt ceiling deal just yet, though talks have been labeled constructive. President Biden and House Speaker Kevin McCarthy, they vowed to negotiate to avoid an unprecedented default. Stocks may largely be ignoring some of that turmoil, but it's a different story in the bond market. Yields on short-dated debt, like 4-week Treasury bills and the 2-year, both climbing. It's not just short-term debt, though. Nordvig says people aren't paying enough attention to the breakout in long-term yields. When benchmark yields rose last year, it was problematic for investors, to say the least. So let's bring in now Nordvig, who is the Exante Data founder and CEO, and co-founder CEO at Market Reader. Also with us, staying for the conversation, we've got Dan Griffith, who is the Huntington Private Bank Director of Wealth Strategy. Great to have you here with us today, both of you. First, help us go further into your thesis there that you were laying out, and particularly, where in the broader bond equation that investors should be paying attention to right now.
Well, so we can go back to September, October, right, when we had incredible volatility in the bond market. And we even had, United Kingdom pension funds were in serious trouble because the bonds were moving so much that they had to hedge them, and it caused all kinds of issues, right? So we've seen a pretty big move up in yields now, and very little talk about it. So I just want to make sure that this is something that's on everybody's radar, because we've been so focused on banking tensions. We talked about it again just a second ago, right? And I think we're having some stability in the banking sector. KRE, or the ETFs that we've learned to watch, right, are trading better. But at the same time, we are not having any indication from the Fed that they are close to done, right? And the curve is pricing cuts. We even had a paper from the Fed on Friday saying that our STAR, which is sort of the long-term interest rates that they model in their fancy equations, is moving higher. There's a lot of things that suggest that the Fed is not done, irrespective of the banking tensions we've had. I'm not saying they should not be taken seriously. But I think it's time to focus on what's going on at the long end of the bond market. The UK bond yield is starting to look like it was in September, October. And we have the debt ceiling news right around the corner. If that goes well, presumably that will lift the whole yield curve a further bit, right? So I think we're getting into territory where that can really drive market.
And this chart, I think, that we're showing right now also shows on the short end, on the very short end, kind of the disconnect, right? So the stuff that has gone down is the stuff that's supposed to be paid before the so-called X date of June 1st. The yields that have moved up, that are viewed as more risky by the market at risk of not getting paid on time, is the stuff that's after June 1st, after that so-called X date. That said, I mean, it's gone up, but looking at that chart, does that say to you the U.S. is going to default? Jens, I'll ask you first, and then we'll go to Dan.
So if you have the choice between buying a T-bill that has, a couple of weeks maturity and one that has a different maturity, and you don't want to be looking super stupid in a couple of weeks, if that tiny little tail risk materializes, you're going to choose to buy a certain T-bill. That's what's going on that chart. If you look at what's going on in capital markets broadly, it's hard to argue that there's a default priced anywhere, right? So this is like a very specific part of the market where it shows up. And I would also note, like, if you look at what's priced in the money market, right, we have 100 basis points of Fed cuts roughly priced in a year, right? So it's not that the market's just thinking, the Fed is about to pause. It's pricing that the Fed is very close to cutting, right? And it's come out a little bit over the last 2 weeks, but it's still 100 basis points that's priced. So it's a big it's a big shift in one direction that the Fed is really not comfortable with.
Dan, you want to get in here?
Yeah, I think what's interesting to think about is how it's affecting consumers at a base level. We see a lot of our clients now asking us, well, if I can get 5% on a money market with zero risk, and we see some potential volatility in the market coming down the line, what does that mean for me? And of course, that's where we have some of the discussions relative to short-term rates versus longer-term rates. I think the thing to think about as you consider moving and reallocating is that not all returns are created equally. We see a lot of clients right now who are saying, I'm going to take money out of my traditional investment accounts, and those things are taxed at capital gains and dividend rates, which are very favorable. And we're going to trade that potential up and down for guaranteed rates, but those are taxed at ordinary income rates. For a regular retiree, as an example, switching to a guaranteed rate and having extraordinary income can do things like affect someone's Social Security taxation. So there's a lot of moving parts to be considered here as well.
But do you think we'll get a deal before that X date?
We think there definitely will be a deal. There's been 78 deals since 1960, and a number of those have been, with some volatility. It's unfortunate that this is replacing kind of the traditional budget process, but I think it's a lose-lose situation for both sides if there isn't a deal done. So we think there will be.
Yeah, although not everybody on both sides maybe sees it that way, right? That it's a lose-lose proposition. So and it's something that the market unfortunately has to deal with every time. I'm curious what you think on what Jens was saying about how the market has been pricing in cuts, right? Do you think that the Fed is going to be cutting rates this year? It seems like everyone we talk to says, not everyone, most of the people we talk to say it's not happening, but yet the market somehow still is pricing that in.
No, and I know we had obviously Jamie Dimon yesterday who came in and said we should expect higher interest rates, not lower interest rates. I agree with you. I think a lot of people in the market are saying, I don't know where these, the volatility would be priced in enough to be able to cut those. So I think, we're a little bit suspicious about that as well.
And it comes back to what the Fed would see in the data to really kind of support their pivot or even a massive cut when really we've had even Bullard come out, I believe it was yesterday, and say that there's still 2 hikes left this year.
Yes, so I think at this point in the cycle, it's totally understandable that the market is hypersensitive to any kind of data that signals a clear turning point, because clearly we are late in the cycle, right? So we can see it with the claims data literally every week. The weekly claims, it's just like 1 week of data can move the market. We even had a situation where we had fraud in Massachusetts and the claims spiked for a totally fluky reason, and the market got freaked out about it until we learned that there was fraud, right? So we have to pay attention to the short-term indicators. Every Friday we have to pay attention to the Fed data on what's going on with lending and deposits and so forth. At Exante Data, we track even like deposits daily, right? Like we've made sure that we have alternative data lined up so we can track what's going on daily. And we still have deposit outflows to some degree. It's not at the extreme speed that it was around Silicon Valley Bank and when First Republic was losing a lot of deposits, but there's still some leakage, so we have to monitor whether that accelerates. So far, it looks like more of a, people call it a bank walk, right? It's like there's a gradual leakage out of the banking system and not like a run on any bank. Yeah.
Yeah. Well, we're going to talk about this much more. But Dan, thank you so much for sticking around with us today. Dan Griffith, Huntington Private Bank Director of Wealth Strategy. Good to see you.
Thank you for having me.